welcome to another Smaulgld live stream. It is the 26th of February 2020, and tonight's topic: is it easier to manipulate gold or silver? Now, first, let's discuss what I mean by manipulation. A lot of people who discuss gold and silver manipulation, what they're really talking about is price suppression, which is a form of manipulation. But a lot of the cases that we've seen recently have dealt with price manipulation, and that could be either on the upside or the downside. So the question is, which is easier to manipulate or to suppress? Is it gold or silver? And what would the incentives be to suppress the prices of gold and silver? Now, it's obvious. What would the incentive be to manipulate the price of gold or silver? Well, that's just monetary gain. That's simple. And that really doesn't matter whether you're dealing with gold, silver, copper, any commodity, LIBOR, whatever you can manipulate. If you can make money from it, you will try to manipulate, or someone will try to manipulate it. And generally, the entities that are in the best position to do the manipulation are going to be the largest traders, because they're going to have the access, or the greatest access to capital, or borrowing, or just general knowledge of the market based on the sophisticated trading strategies and equipment that they may have at their disposal. And we've seen a lot of the big cases have dealt with price manipulation by the large money center banks, and they have been caught manipulating not just gold and silver, but copper, aluminum, LIBOR, and other commodity markets. And oftentimes that manipulation takes the form of spoofing and trying to front run trades either on the upside or the downside, and they really don't care whether the price of copper is going up or down as long as they profit from that price movement. So I don't think there's any mystery, or anyone could even possibly deny, that the gold and silver markets are manipulated, have been manipulated, and will continue to be manipulated. All markets, someone's going to try to manipulate markets. There's no such thing as a pure market, as a free market. You generally have regulators who try to stop it, or even don't try to stop it, or part of the problem. Doesn't matter. Manipulation comes with markets. The problem people have, though, with gold and silver is they believe that the price of gold and silver is suppressed. Now, one could argue that by manipulating the price either up or down, that's a form of price suppression. We say, well, how can the price be manipulated, suppressed, if the price is manipulated higher? Well, because if it's manipulated higher artificially, it gives people false signals. They're tired of the roller coaster, and they just can't be bothered with the market altogether, and they just get out. Well, I'm not sure if that's really a disincentive to long-term purchases of buying a commodity if you believe in the long-term value. What I want to talk about now is price suppression. And price suppression is really at the heart of the manipulation argument. Because, as we've just said, you can manipulate up or down any commodity, any index. Doesn't really matter, and it's nothing particular about gold or silver. It's about making money. However, there is and has been evidence that the price of gold has been suppressed. Not necessarily just manipulated for profit, but suppressed on purpose. And the classic example is during the Bretton Woods Agreement. The agreement said that foreign central banks could bring their dollars back to the United States and exchange them for gold at $35 an ounce. Now, that was the price of gold that was arbitrarily picked back in 1934 when Congress set the price of gold at $34 an ounce, increasing it after Franklin Roosevelt's executive order, I think it was 6102, from the price that was then set at $20.67 up to $35. And that was the price of an ounce of gold, and that was basically what a dollar was worth, an ounce of gold. And an ounce of gold was worth $35. And that price remained in effect from 1944 to 1971. Unfortunately, though, if you think about it, it doesn't make any sense for anything to remain fixed at a certain price over the course of 30, 40 years. And that's indeed what happened with gold. And it took a lot of manipulation in order to try to keep the price at $35. From 1944, when they started the Bretton Woods agreements, allowing foreign central banks to bring dollars to the United States and get them exchanged for $35 an ounce, for gold, a lot happened. The world economy grew, especially the European economies, and then later the Asian economies in the 60s started to grow as well. There just wasn't enough, there weren't enough dollars in circulation or at that price to back all the gold. Now, one of the quick fixes to that could have been, well, you just let the free gold price rise and everything would be fine, but the United States didn't want that. That would, in effect, devalue the dollar. They didn't want to do that, so they try to keep the price at $35 an ounce. That is price suppression. They had a thing called the London Gold Pool, and they did all types of manipulative tricks to keep the price of gold at $35. Eventually, they just couldn't do it at $35. Now, the reason for that is that was done for monetary reasons in order to manipulate a gold standard, an ill-fated gold standard from the start. Trying to say that it was a gold standard was a bit of a misnomer. It was a dollar standard backed by gold rather than just every currency being pegged to a certain amount of gold. It was basically the dollar was supposedly as good as gold, and you know that can't be the case. So that's a clear case of gold suppression. And in a gold standard of that sort, there's an incentive and almost a need to suppress the price of gold. And in fact, not allowing Americans to own gold was a form of price suppression, which meant there would be no pressure by private citizens buying gold at all. And therefore, the banks could try to manipulate, or pools could try to manipulate the price of gold. Gold then, after the gold standard was abandoned by Richard Nixon in 1971 and they allowed Americans to purchase gold, they then instituted COMEX trading. And the reason they instituted COMEX trading, one of the reasons was to disincentivize people from actually hoarding gold and to try to make it, to demoralize people who would think they were going to get a quick profit in gold, because they knew as part of the COMEX trading that traders could buy and sell gold on whims. Because gold does not have a clear-cut demand. The gold demand, when there's a gold standard, was based on the amount of dollars, and you could figure out some monetary formula. But once gold goes into the free market and the bulk of gold demand is half monetary, you really don't know how to gauge that demand. Now, you can gauge gold demand somewhat by the other half of its demand by jewelry. And in a sense, the higher the price goes, perhaps the lower the demand for gold goes. But jewelry is not a necessity. In fact, gold is not a necessity at all. Someone made a comment in this section from last night, essentially saying that you don't really need gold at all. But here's the thing with the difference between gold and silver. Silver, we talked about last night, is a commodity. And there is a fixed demand for silver for certain commodity uses, of which there is no substitute, or at least no readily available substitute. And that creates a problem when you try to manipulate the price. You can manipulate the price of gold when gold is, in a sense, a discretionary purchase. So here's what I mean. If someone's interested in manipulating the price of gold or silver up and down, we've already said that's not anything surprising. That can happen with any commodity. But let's say your goal is to manipulate the price of gold lower for whatever monetary reason. You think that gold is the anti-dollar. You don't want the dollar to look bad, so you manipulate the price of gold lower. Now, one can argue that might create some additional gold demand for jewelry, because people would see the lower price and they would race out and they'd get themselves some gold for jewelry. Being that it's the lower price, you can get gold. But it's not the same thing as when a commodity is on sale, like milk. Now, milk you can't store, but when you've ever seen in the grocery store and they have sales on milk or eggs, people buy more of it. Similar concept exists in gold, but it's not really the same, where people rush out and they say, oh, you hear that gold has gone down $20 an ounce, I better go out and buy a gold ring. Doesn't really happen. The other thing that really prevents that dynamic from taking hold is, at least in the United States, when the price of gold drops, that's actually a disincentive to buy gold. people think, oh, the price of gold is falling, it's going to fall lower, I'm not going to buy any, maybe I won't buy any until it falls even lower, and Americans tend to chase the gold price. So you somewhat can manipulate the price of gold because gold's value is largely psychological. Even buying a ring is psychological or emotional. It's not so much that people can actually pinpoint how much gold is worth. It's really how much gold is worth to them at a given moment, how much they think gold might protect them against future events, inflation, coronavirus, whatever it is. But really, as we discussed last night, how can you actually value gold based on your concern or fear over an upcoming event? You think the dollar is going to go down, you think the euro is going to go down, you think there's going to be a debt crisis, you think there's going to be a war, you think there's going to be a pandemic. But what's the value of gold? Now, some people will buy gold at any price because they think the world's coming to an end, and buying gold is somehow going to save them from the end. And then you have people who buy gold or would buy gold along an entire spectrum of their own personal views on how valuable gold is. And then there's some people who would never buy gold. They don't think it's valuable at all. But the point about gold is it can be manipulated because it's very hard to pick a market price for gold that people can agree on is based on supply and demand. And I mentioned milk and eggs. Well, that's a pretty obvious one. If there's tons of eggs in excess for whatever reason, or milk, then those eggs and milk will be sold at a lower price because they've got to get sold down because there's an excess of eggs and milk in the market, and the only way you're going to get rid of those eggs before they go bad is you have to lower the price. So it's obvious to see how a market dynamic can handle pricing pretty easily with a commodity that has a fixed or somewhat of a relative demand that happens on a daily basis. You don't wake up in the morning and think you need to have gold on any particular day. It's a very personal decision when and how much gold you're going to buy. And for the most part, most people don't buy gold every day. So there's where it's very easy to manipulate gold, because if you're trying to manipulate gold, you're not going to really run up against market forces. You're not really going to cause a rush into gold jewelry, which is going to impact your manipulation if you're trying to suppress the price. And indeed, if you do suppress the price, the suppression itself may cause less buying because people are fearful that the price is going to go lower. So I believe that price suppression in gold, there is an incentive for central banks or other entities to try to suppress the price of gold, and I believe they can do it. And I believe it has been done, and there's documented examples. If you look up Smaulgld, I've done 2 extensive blog posts and videos on this. I think one is called Real Examples of Gold and Silver Manipulation, and the counter one was Suspected Gold and Silver Manipulations. And in both instances, we have the actual examples where they've been caught dead to rights manipulating gold. To say that there's no manipulation is ridiculous. The Fed manipulates interest rates on a daily basis. They either talk about it or they actually try to set interest rates. That's a form of manipulation. So obviously, if there's an economic interest, a government interest, a central bank interest to manipulate something, be it gold or anything else, then I think it's foolish to say that they don't do it, can't do it, and wouldn't do it. They do it. And they can do it because gold, as I mentioned, doesn't have any fixed demand. That brings us over to silver. Now, silver, the argument that you can easily easily suppress silver is harder to justify, and here's why. If you're trying to manipulate gold, in many instances, even if someone is interested in buying gold at the lower price, the manipulated lower price, the suppressed price, well, if there's a extra created demand for that gold, you could say, but then people will rush into the market, they'll purchase the gold, and that'll just drive the price back up. Au contraire, they can buy gold substitutes. They can buy paper contracts, they can buy ETFs. They don't ever have to buy the gold, which means that you can manipulate the price, and the additional demand that you get from manipulating the price or suppressing the price will be satisfied with gold substitutes, paper substitutes, digital substitutes, and so on. And that means that gold can be manipulated, can be suppressed relatively easy. And again, the only thing that would really jump in and harm a manipulation or a suppression scheme would be some type of massive rush to buy physical gold in the form of jewelry or bullion. And we've seen there's been instances where it's been hard to manipulate gold because that dynamic can exist and has existed where people just say, this is just too good of a deal. I'm going to buy the gold at the manipulated lower price, and then the price goes higher. Silver, however, is much more difficult. And this is where I think the people that pump silver have got it 100% wrong. They claim that the central banks are most frightened of silver. Nonsense. Gold was what they have viewed as, and as Rory Hall pointed out in the comments last night, he says gold is a tier 1 asset. This makes gold the same as currency, bonds, or other tier assets that function like money. Silver is not. Now, that is correct. Therefore, if central banks are viewing their gold as money, they obviously have an interest in what the price of their money is. So clearly, they're going to have an interest in manipulation one way or the other, and most likely suppression. Silver, they have no real such interest as they have any more than they have. They probably have a greater interest in oil manipulation than they do in silver manipulation. So gold, you can see while the price may wish to be, they may wish to suppress the price in addition to just the general wishing to manipulate a price just to make money. That could be up or down. But silver, it's not the same thing. There's not the same incentive to manipulate silver. However, silver, as we also mentioned last night, is a much smaller market, which means the amount of resources it takes to manipulate the price of silver up or down or to suppress the price would obviously be a lot cheaper. Now, you would think, well, because it's a lot easier, then it must happen more often. Well, I would say yes. It probably happens more often on the manipulation, but on the suppression side, I don't think it does happen. Just because it's easier, I don't think that just because a market is easier to manipulate, that would mean that you would try to suppress that market. And here's why suppression doesn't make any sense for silver. First of all, the incentive, as I've just mentioned, is not desirable in the way it is for manipulating the price or suppressing the price of gold. Central banks don't hold silver. Silver is not considered, it may be considered on silver pumper channels as a monetary threat. It's not considered rationally or credibly to be a monetary threat to anybody. There's no groundswell political movement like there was at the end of the 19th century with the Silver Democrats. There's no movement to make silver an everyday currency. You can talk about these bills that have been passed to have a depository in Utah or Texas, but no one or very few people actually believe that that is a viable or a populist type of movement that has any traction whatsoever, that people are going to start carrying around bags of silver and using that as a currency. So therefore, if that's not a viable threat, then central banks really have no interest in manipulating it, no matter how, or suppressing it, no matter how easy it might be because of the size of the market. But there's another reason. It's not easier because of the size of the market for another reason. Silver is a commodity, and silver, as we mentioned, in a sense, like milk and eggs, does have a daily requirement, a daily demand for use, mainly in electronics and solar panels. When gold demand rises, we mentioned, through perhaps suppression, the price gets lower and then the demand rises, gold substitutes can be employed to keep the manipulation or suppression scheme in place. Someone wants more gold, someone wants a ton of gold, you sell them a contract. They just want the price action, they don't really want the gold. Or you sell them an ETF and maybe the ETF adds the gold, maybe they don't, maybe they count on other people selling it. You can get away with in a manipulative scheme or a suppression scheme and not actually having a one-to-one correspondence with the amount of gold that you're manipulating. We see it all the time. COMEX trading, they trade around a pile of gold on the assumption that most traders aren't going to ask for delivery. So they'll keep a certain amount of gold in the COMEX vaults, and that'll be enough for the people who actually want to take delivery far, because most of the traders don't want to. But here's the problem with silver. if there is a fixed commodity supply, forget the investment amount, because the investment amount is only 15%. And most of silver investment demand can easily be met by minting of silver bullion, silver coins, and then, of course, silver substitutes like COMEX contracts, ETFs, and so on. But the bulk of silver's demand, physical demand on a daily basis, not on a, well, maybe I'll buy some gold today, but on a commodity basis, on a manufacturer's basis, where they have to have a certain stockpile of silver, they have to have a certain amount of silver and other commodities on hand to produce their electronics or solar panels or their industrial products, they have to have silver. Well, if there really was some scheme to suppress the price of silver, that wouldn't work, because a lower price of silver, something that people need, they're going to buy it. And they're going to buy it when the price is low. And that should put pressure on the price of the commodity. But that doesn't happen. And the reason it doesn't happen is that the price of silver, from a commodity standpoint, should reflect the supply-demand dynamic. And I want to read another comment by Rory Hall at the Daily Coin. He made another important point. And that is, okay, here's what he says. Lewis, you and I picked apart the Silver Institute annual report 2 years running. I think we did it for 3. And we found there was more than 1 billion ounces in deficit using their manipulated numbers. And now you're saying, excuse me, there is more demand than what is being mined. These two items run contrary to each other. And yes, indeed, they do. We pointed out that according to the Silver Institute, there's a certain amount of silver mined every year, or a certain amount of silver that also comes to market as part of the mining, primary mining, secondary mining, and then silver that comes to market as part of secondary supply of people just turning in their old silver, recycled silver, if you will. And then there's a certain amount of silver demand that is a function of industrial use, jewelry, silverware, and investment demand. And according to the Silver Institute, they just showed, I think it was like 15, 20 years in a row, there's pretty much a deficit, meaning that somehow the supply of silver does not meet the demand. Now, generally, if that happens, it works itself out. And if you have a deficit where there's more demand than there is supply, the price has to rise. And in the last 10 years, we haven't seen that happen at all, which leads me to believe, as we mentioned last night again, that the demand may be, the numbers may be wrong on both sides. They may have the wrong demand numbers, they may have the wrong supply numbers. But what I think is happening is they have the wrong supply numbers. Because I believe the market is served by the supply that's out there, the existing supply, the primary mining supply, the secondary mining supply, and the recycled silver. Because if there wasn't that supply, then we would have, if there really was a deficit, we would have a shortage of silver, meaning we would be seeing things like, can't make the delivery of these electronic devices because we're lacking the silver, one of the necessary components in order to make this electronic device. Sorry, there's a delay on your solar panels. We can't make them. Now, there may be a delay on solar panels just because a company can't keep up with production quotas. That's different than not having enough silver. We haven't heard of that. We have not heard of someone not being able to meet their industrial needs because there's a silver shortage. Now, what we have seen with silver from time to time, we saw it especially in 2015, and people called it a silver shortage, and it wasn't, and the Perth Mint made sure to let people know it wasn't a silver shortage. What was happening was, while there was a very big increase in investment demand, it wasn't that there wasn't enough silver around to meet the demand. There wasn't enough silver that was pounded into planchets so that they could strike the silver eagles, the Canadian silver maple leafs. And the reason for that was they were all using one or two suppliers to supply the planchets. So that's the difference between there not being enough hamburgers at a picnic because the people can't take the beef, the ground beef, and put it into patties fast enough to serve the demand, than there being an actual beef shortage. So, when you say that the price of silver has somehow gone has been manipulated down, it wouldn't make any sense because you cannot substitute silver. There is no, the way you can substitute gold demand when the price is low, you can do it with gold substitutes, paper contracts, COMEX contracts, digital forms of gold, ETFs, and so on. If there's an actual increase in demand for silver, you cannot, and because most of the demand, 70% of it is for commodities, you can't substitute, you can't say, okay, we don't have enough silver to make solar panels this week, so we're just going to buy some COMEX contracts and stick them in the panels. That doesn't work. And that's why you can have suppression of silver price, because if you had it below its fair market value, because if you did, the commodity would be bought up, and that in a sense would rebalance itself. Either you would create a shortage and the price would have to rise. You just can't have the same type of ease of price suppression that you have with gold, because as we mentioned with gold, there's no one needs gold. You don't have to have gold. Now some people who are gold bugs think it's a necessity, but most people do not view it as something that has to be had on any given day. Whereas for a manufacturer, the silver has to be had on any given day. Has to be had on any given day in certain amounts. And you cannot do that. You cannot substitute silver demand the way you can substitute gold demand. So let's see what you guys think. But in closing, I believe that there is, for both gold and silver, manipulation happens all the time on the upside and the downside, and that's spoofing. And I don't think there's anything unusual about that. And anyone who thinks that doesn't happen is not, that happens in all markets. So let's just dispense with manipulation. As to price suppression, I do believe, and we have examples of it, that the price of gold has been suppressed, can be suppressed. There's an incentive to suppress it, and it happens. And what helps it happen is that when the price gets lower and people decide to dive in, there's enough gold substitutes that can prevent the increase in gold demand from pushing the price higher. And as I mentioned, jewelry demand really doesn't ratchet up. It's not like it causes people to rush out to buy gold jewelry just because the price is low. People may wait for it to get lower. The times where it works against the suppressors is when people really fear and they really panic. And as you saw in the 70s, the gold lines, or you saw in Germany when they changed a law just last year where they say you're going to have to report gold purchases made at a gold shop under $10,000. Then you get these rushes into gold where people feel they have to have it. Well, doesn't exist for silver because there is not the incentive for central banks to suppress silver in the way there is to suppress gold. And the bulk of silver demand is as a commodity, and as we've seen with commodities, when the price is either suppressed lower, which you generally wouldn't do, you just manipulate it lower. Generally, that is a self-correcting event. So where there's a lot of extra eggs, a lot of extra milk, then the price will be lower during that time, but they'll all get eaten up, and then the price will reach back to the equilibrium where there's a more normal supply of the milk of their eggs. And it's the same with silver. If silver went down to $3 an ounce, you bet that large manufacturers would just buy as much of it as they could and store it. There would be no reason not to do that, and that would just drive the price right back up. So that's the difference between gold and silver. They're both the same in terms of manipulation. They both can easily be manipulated on the upside and downside. But on the suppression side, it's actually easier to suppress gold, even though it's more expensive to do so, because A, there is an incentive to do it, and B, you can substitute extra demand for gold at lower prices with gold substitutes in paper and digital form, where you cannot substitute excess silver demand based on price suppression. You cannot put COMEX contracts in solar panels, electronics. You can't buy ETF shares and say, well, now we have our silver, we don't have anything to worry about. All right, let's see what you guys are thinking over in the comments section. We got Black Swan, Max Strong, and Fiona here. And that's about it. And it looks like not a very chatty group tonight. Sometimes you guys talk amongst yourselves. All right, I want to thank you for joining me tonight, and we'll see you soon. Thank you very much.